Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, we break down the latest on the trade front as Trump says more tariff letters are coming today. Plus, we'll get a read on international versus U.S. equities, which is the better buy right now, we'll discuss. And we'll break down Samsung's product announcement. What does it mean for smartphone competition in that market? Let's get a check on the markets right now. Take a look at stocks that are rising across the board here. The Nasdaq leading gains up 1%. The S&P 500 gaining about 2/3, and the Dow up about 228 points right now, about 0.5%. Why is the Nasdaq leading? It is getting an assist from Nvidia, which has now hit $4 trillion in market cap, and the stock is at a record with that 2.5% gain that we are seeing here today. There was no particular catalyst in today's session that was leading Nvidia shares higher, just more of the flows that are going into large cap technology that we've been seeing. Let's talk more about all of this. And for that, I want to bring in my contributor for the morning. That is Kevin Gordon, Director and Senior Investment Strategist at Charles Schwab. So Kevin, we've all been sort of waiting for this Nvidia move, $4 trillion, a big milestone for the company. What does it mean for the recent tech trade that we have seen? I mean, sometimes when we look at this kind of move, we're like, is this the end of a move or is this the beginning of the next leg?
Well, I think what's interesting is that this is not just an Nvidia story. It's not necessarily just a mega cap story. If you look at the breadth of semis as an industry, it's actually improved quite sharply over the past few years relative to where we were. A couple of years ago, you were at 0% of those companies. If you're looking at the industry in the S&P 500, none of them were above their 200-day moving average. Now you've gotten to above 80%. So this is not just a one stock story. This is not just a mega cap story. I think that there has been some pretty significant movement under the surface. So I think that's a positive thing from the standpoint of, you look at the largest companies in the S&P. The 5 largest companies by the end of the second quarter, they made up just slightly less than 30% of the S&P 500's market cap. So that concentration risk has definitely crept back into the market, but it's not being accompanied by just a few stocks that are leading the market higher that are actually outperforming. There has been a pretty significant, resurgence in breadth across, not just within semis, but across other, parts of the cyclical components of the market too. Things like industrials, like financials. That's where leadership has been concentrated. And I think that's been a really important story.
And so do you think that the move that we've seen in semis, which, as to your point, has been broader than just large cap tech and the largest like Nvidia, do you think it still has room to go?
I mean, if you're going to use breadth as some kind of indicator, yeah, I think there's probably, and I would say up the cap spectrum, much more in the large cap space as opposed to the small cap space, because even within the moves that we've seen in the, what's thought of as the growth world, the mega cap growth stocks, actually, if you look at Russell 1000 growth and Russell 1000 value year to date, their performance is almost identical. Huh. So it's not necessarily this growth versus value thing, but if you look at Russell 1000 growth versus Russell 2000 growth, there's a much bigger discrepancy in year to date.
In other words, small caps
exactly.
Are
so it's been more of a cap factor story than it has been in terms of, is this just a growth trade or a value trade? There's been almost this sort of sweeping performance from the larger names, but even in Russell 1000 growth, I mean that's almost 1,000 companies, or 1000 value. That's almost 1,000 companies in each index that are doing well. So again, it's not just a mega cap story, but in the broader large cap universe, that is where the strength has been so far this year. And I think it's a reflection of where we've been in terms of tariffs and where tariffs have taken, the trade war has taken the biggest bite. It's been at the smallest end, not necessarily at the largest end.
Well, I'm glad you brought up tariffs, because that's what we're going to go now. We're going to go to our Ben Werschkul for an update. President Trump says that at least 7 more countries can expect tariff letters on Wednesday after 14 leaders received notices outlining new rates from the U.S. So here, with what we can expect in this next round, our Washington correspondent Ben Werschkul is back with us. So Ben, what are we looking for from this new batch of letters?
For sure. Yeah, we're still waiting for this batch of letters from Trump. He's promised at least 7 this morning and more in the afternoon. So far this morning, he's posting on Truth Social about Jerome Powell. So I guess maybe the trade topic will come next. But the bottom line here is that markets are already kind of looking past these letters, because what we know is that these letters are going to have an August 1st implementation date. Trump announced that on Monday, and so there's a lot of skepticism about whether whatever rate he dictates today will be the rate that we actually see on August 11th. And we're seeing skepticism even deepen this morning after some new comments from Peter Navarro on Fox Business. The word he used to describe the letters is negotiations, which is a very different message than we've heard in recent days. That earlier in this week, letters were akin to either a final deal or, as Trump put it, a deal. That was the deal, or the final word, or all these different things. Now, if this is just a sort of negotiating tactic, how seriously are markets going to take it? And it also comes as a lot of the focus and the actual movement we've seen this week is along a wholly different tariff track, which is the sectoral tariffs. Trump announced that we'll be seeing 50% tariffs on copper by the end of this month. That joins 50% tariffs on steel and aluminum, sort of with a focus on these metals that are coming in higher than people expected and has seen a real movement on copper prices. A lot of other sectoral tariffs are coming down the pipe too, which Trump has been talking about. He talked about 200% tariffs on pharmaceuticals after a lead-in period in the next couple of years. And also Navarro even brought up semiconductor tariffs, which is another big shoe to drop here. He described Apple as thinking it's too big to tariff, but suggesting that could not in the end be the case as we wait for these semiconductor tariffs, which will apply across the whole world, including to China.
Ben, thank you so much for the update. Appreciate it. Well, as the president has ramped up deal-making pressure on U.S. trading partners in recent days, he said his August 1st deadline would not be extended. Joining us now, Wendy Cutler, Vice President at the Asia Society Policy Institute. She spent nearly 3 decades shaping U.S. policy within the Office of the U.S. Trade Representative. And also with us for the morning reminder, Kevin Gordon, Director and Senior Investment Strategist at Charles Schwab. Wendy, so we've got this latest tactic of the administration. The Wall Street Journal reporting this morning that part of the reason the administration pushed things back to August 1st was because Treasury Secretary Scott Bessent had asked the president for more time. He said he was making some progress on these frameworks and that he needed a little extra time. What do you make of what we've seen so far in terms of some of these agreements between the U.S. and other countries?
Well, clearly we haven't seen 90 deals in 90 days. The 90-day period now is up. There are 2 deals that have been announced, one with the UK and one with Vietnam. And even with Vietnam, it seems that we're still negotiating with them on many of the important details. Look, as a former trade negotiator, the minute I heard about their objectives here, I just thought they were totally unrealistic. Trade negotiations take time. And the notion you're going to be simultaneously negotiating with dozens of countries just really limits the bandwidth of the negotiating teams. And so, yeah, I think more time is needed. And, August 1 now is the next deadline. And even though the president is saying there'll be no more further extensions, I think our trading partners are beginning to realize that this may go on and on and on.
Wendy, I mean, from a non-professional trade negotiator's seat here, it feels like the administration is content in many cases to just get sort of headlines, right? That they've agreed upon the very broadest outlines for these deals. What then is the risk that they get the outline and then as the negotiations go on to figure out those details, that they're not entirely favorable to the U.S.?
Well, I think the risk is going to be, as you have all these follow-on negotiations to hammer out details and important details, that we're going to see more bumps in the road and probably more tariff threats, because I don't think these follow-on negotiations are going to go smoothly either. And so what I keep telling people is we need just to be ready for living in a tariff world for the next 3.5 years. And when you add on to that, the rollout now of these sectoral tariffs, starting with copper, but there's 6 other active Section 232 investigations where other tariffs can be announced and rolled out. This is going to make these follow-on negotiations even more difficult.
Kevin, what I'm really curious about as we, what Wendy is talking about, and even if the trade deals happen, right, we're still looking at a higher overall tariff rate than there was before. Why? I guess it's just that the market sort of gets accustomed to almost anything. Is that why we're not seeing more reactions here?
Yeah, I think the biggest thing, if you're comparing now to Liberation Day, is really the speed with which this is happening, which you could argue now it's much slower. It's a rollout to August 1 versus when you had April 2nd, it was hitting all at once and it was literally everything and everywhere. So there's a very big difference in terms of the severity of what's being targeted. But also just the timing to get to that point. Plus, we know now that back in early April, as serious as the administration was at the time, from April 2nd to April 7th, you could say about getting to really aggressive tariff rates to presumably, close trade deficits, rein them in, and then have more produced in the U.S. It doesn't seem that that's the goal right now. I think if it were, then you wouldn't have had a shift from April 2nd. You would have gone through this really long and I would argue, painful process of having to try to close trade deficits with all of these countries. So I think the market's view of this and why things have been relatively sanguine, so far this week, despite some of the weakness earlier in the week, I think a lot of that has been, on the premise of, what was mentioned in the segment leading up to this around just general skepticism. Is this going to be implemented? Are there going to be sort of different deals and frameworks for different countries? And also, is this going to be on a different timeline? I think that really matters for this, especially because, going into this, even before all of these letters got sent out, we knew that the deadlines were different for China, for Canada, for Mexico, even for Vietnam. So I think that has become more the focus as to what is actually going to be targeted and when. And now that the fact that we know that this is being delayed, I think there's I think to some degree, rightly sort of assumed by the market, some general degree of skepticism because there's no knowing what the ultimate goal is.
Well, yes. And Wendy, we need to remind folks also that while these negotiations are going on, these countries are paying the tariffs, right? Importers or exporters to the U.S. are indeed responsible for these tariffs, and you've got a considerably higher overall tariff rate than there was before. So how do we try to figure out what the end game is at this point?
Mm-hmm. And I think there's going to be a lot of push and pull here. Particularly when we start seeing these tariff rates in the supermarkets or in the retail stores. To date, the price increases have not been dramatic. Many companies have been preparing for this and stacked up their inventories, but these price hikes are going to start to hit. And particularly with respect to consumer goods, who knows, we may see going forward that large chunks of products are exempted from these tariffs as well, and therefore they wouldn't have as sharp an impact as if they would have if they were blanket tariffs.
Do you think overall that this latest tactic is going to be ultimately effective when it comes to these deals?
Look, I've been quite surprised that countries have, at least publicly, been pretty determined to reach a deal with the United States and have talked about, we're going to come to Washington, we're going to see what more we can do, we want a deal. Now, privately, they're saying very different things. They're frustrated, they're angry, they don't know what the end game is. They feel that, the administration keeps changing, the priorities and just a lot of confusion. But publicly, I think we're going to see intense negotiations over the next 3 weeks, and I suspect we will see more deals announced by August 1.
All right, we will keep on trying to tally them. Wendy, thank you so much. And Kevin, of course, is going to stick around. We got much more markets action coming up, including this rally that we are seeing in large cap tech. You're watching Market Catalysts. Now time for some of today's trending tickers. We are watching AES, WPP, and copper miners. First up, power provider AES is rising after reports from Bloomberg that the company is exploring a potential share. Shares up on the news that the renewable energy provider, which owns wind and solar farms in the Midwestern U.S., could be looking for a buyout. The company provides energy for AI data centers, and the shares are surging some 17% here. Bloomberg is saying that there are some infrastructure companies that might be, or companies that invest in infrastructure that might be interested, the likes of a Brookfield Asset Management or BlackRock's Global Infrastructure Partners have potentially been looking at that. AES shares had been underperforming, so that's one of the reasons that it could potentially be attractive. Kevin Gordon, of course, is still with me. And Kevin, I have been fascinated by the move in utilities
Yeah.
over the past year, or really couple of years here. And so AES just sort of another example of that, even though that stock has not been performing, that this has been, I mean, utilities, we all know utilities are boring traditionally, and yet data centers have made them unboring.
You know, it's interesting. Yeah, they've put themselves out, or AI has sort of taken them out of the boring category. And especially when you think about the sort of trifecta of traditional defensives being utilities, consumer staples, and healthcare. You know, utilities have really pulled out of that group over the past, I'd call it year and a half. You could date it back to when, you know, Nvidia kind of sparked the AI trade initially in 2023. But from a breadth perspective, from an earnings perspective, utilities have really started to move themselves, you know, out of that pack, which I think is interesting because from a secular, you know, power generation standpoint, if that's a theme that's really going to get up and going, especially if you look at a sector that is maybe more immune to tariff pressure versus the other two. You know, healthcare with everything pharma in terms of sectoral tariffs and staples, you talk about a sector that traditionally has really thin margins and can't really navigate a lot around cost pressure. You know, that automatically keeps them in more of the back seat versus utilities. And I think it's interesting, even if you look year to date, I mean, the breadth profile is completely different for utilities versus those two other sectors. So I agree, it has been a really interesting story as to how that sector has been able to differentiate itself.
Yeah, well, we'll see what happens in the case of AES, whether it does indeed result in the buyout. I'm watching shares of WPP as well. They're sinking after that marketing and ad giant warned that sales are falling behind expectations. The shares are down double digits after it cut its full year revenue outlook. It's now expecting sales to fall between 3 and 5%. And we're seeing some of its competitors, Omnicom, for example, also fall. And this really, Kevin, speaks to the broader trend of ad sales about, you know, what's happening with the consumer, but also the changing way that brands are getting to their potential customers. And I'm wondering, sort of bigger picture, whether you're watching that trend of the ad sales of the consumer trend and what effect that's having.
Well, it's that plus it's changing trends, but it's also, if you look at the broader, from a macro point of view, even if companies are beating on earnings or beating on revenue, or if they have just generally inline results, I think the most important thing you mentioned, not just for, you know, this particular company, but any company in the, you know, the past earnings season, and what we're really watching for in the upcoming earnings season is whether there are cuts to the outlook and whether there are cuts to guidance. Because if you can hold, if you've proven that you can hold your guidance pretty clear, pretty firm throughout this entire, you know, backdrop of some consumer weakness, but also just general, you know, pretty significant macro instability, then you've been rewarded in the market. And, you know, the market generally looks for things that are scarce and puts a premium on it. Right now, I would say the premium is being put on companies that have relatively stable or growing margins, but that also have generally solid outlooks, because that's a shrinking number as you get into a more precarious instance for both tariffs, but also, I would argue, for labor policy too.
Yeah, and then finally, the other group of trending tickers I want to talk about, copper miners. They're on the move, of course, after President Trump suggested a potential 50% tariff on the precious metal. The president hasn't yet confirmed, of course, but we saw many of these stocks move. They're pulling back a little bit today, but the move effectively was underlying copper prices spiked yesterday and then came down, and that happened with some of the copper miners. Freeport-McMoRan, copper and gold, a particularly interesting example of that. And I'm always interested to see the sort of relationship between an underlying commodity and then the miners or the companies that are associated with it, whether you're talking about oil and oil production companies or miners and the underlying metal. How are you looking at this whole copper situation?
Yeah, you know, it's fascinating because of the initial stated tariff rate, which is pretty extreme when you look at, you know, the rate of going from almost nothing to 50%. That in and of itself is extreme. Whether that becomes the case and you actually see that manifest is a different story, because we don't have any details as to what, you know, when it gets implemented or how, or if there are going to be any carve-outs or exemptions. I think the exemption portion is going to be really important because a huge chunk of our copper imports come from Chile. So if that's carved out and exempt, then you probably don't have that much of a hit to, you know, certainly to overall GDP, but even for the average effective tariff rate in the US, probably doesn't get boosted a lot from that actual import. But you're starting to see it, you know, a little bit in the market. Yesterday there was a huge spike in, you know, the number of stocks in the materials sector that were, you know, making new highs. So there was an initial knee-jerk reaction. I'm not sure how much we should extrapolate that, especially because evidenced by this morning, you're starting to see a little bit of reversal.
Yeah, and as we know, there's the headline, and then there's whether there is follow through and details. Exactly. As for these trending tickers, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, a report from CNBC suggests Starbucks has received bids on its China business, valuing it at roughly $10 billion. According to that report, Centurium Capital, Hill House Capital, Carlyle Group, and KKR are those potential contenders. Yahoo Finance senior reporter Brooke De Palma joining us now. So, Brooke, what could this potential deal look like, and why is Starbucks potentially looking to sell this unit?
Right. Well, what we're looking at here is that Starbucks intends to keep a majority stake. And so that stake would be around 30%. And then the rest of the buyers here would hold less than 30% if they do indeed sell this business. I want to dive in a bit to those potential buyers. When you take a look, I do want to note that Centurion Capital actually is a majority shareholder of Starbucks' top rival in the China market. That's Luckin Coffee. So it would be interesting to see if they do move forward to hold a stake in Starbucks China business. But a Starbucks spokesperson told Yahoo Finance, quote, "We see significant long-term potential in China. We're looking for a strategic partner with like-minded values, and we remain committed to China and want to retain a meaningful stake in the business." Once again, that could look like around 30%. But this has been a company that has struggled in the region lately. We see shares rising up more than 1% in early hours trading this morning after the company had turned flat as far as same-store sales growth last quarter. But that was after a couple of quarters of negative sales growth, dropping as much as 14%. And what I've heard from sources within the area is that they've struggled to really keep up with Luckin Coffee, with Yum China when it comes to that low price model, really rapid innovation. They're constantly churning new items to keep those Chinese consumers engaged. And in addition to that, when you think about the sheer store presence that Luckin Coffee has versus China's Starbucks. Starbucks in China only has about 8,000 stores. Luckin Coffee has more than 20,000 stores. And so just really struggling to keep up here, and investors certainly really looking and waging what exactly this sale could look like.
And of course, the talk here at Yahoo Finance offices has been that Luckin is opened close to our office. So obviously Luckin is also now sort of meeting Starbucks on its home turf. What do we know about their plans in the U.S.?
Yeah, one analyst actually noted in a note that she had gone to that Luckin Coffee she had visited, and it actually was a bit higher priced than what she had thought when it came to the matcha and the lattes. And so it's interesting to see. Luckin Coffee certainly has won over their playbook in China. When they expand here to the U.S., will they sort of change and iterate their model based upon what American consumers are willing to pay up for?
Right.
And so certainly that's something to look out for. We know that Yum China, Luckin Coffee, they have an eye and a pulse, but opening up in New York, a big move for them, certainly goes to show that they're not just a competitor in China, but really looking to become this global presence as well.
Clearly, we need to go do some market research.
We absolutely do, Julie.
All right, thanks, Brooke. Appreciate it. We got much more markets action coming up. Stay tuned. You're watching Market Catalyst. 1 hour into the start of trading, let's go live to the NASDAQ to get a read on the biggest factors moving markets today. Ali Canal back with us. So big cap tech is definitely helping lead here.
Oh, big cap tech is helping lead. Whereas NASDAQ as the biggest gainer right now, up about 0.8%. Now, we were up around 1% a little earlier, so slightly off those highs that we saw earlier in the session. The S&P 500 up about 0.5%, and the Dow up around 0.4%. Now, this comes after Nvidia hit that $4 trillion market cap. Currently, we are just slightly off of that, but it's the first publicly traded company in history to hit this milestone. So a historic day for markets. We're also seeing gains for other big tech players, Microsoft, Amazon, Alphabet, Meta, Broadcom, all up around 2%. Even Apple is up marginally this morning, and this comes after comments from Peter Navarro on Fox Business. He said that Apple thinks it's, quote, too big to tariff. That took a bit of steam out of shares, but we're now seeing the stock trade in the green. And I finally want to take a look at this post from President Trump, because he is now calling for at least 300 basis points worth of cuts from the Federal Reserve. We know the president has been ramping up his rhetoric against Federal Reserve Chair Jerome Powell, calling him, quote, Teat Powell. He's currently on the hunt for that new Fed chair with Kevin Warsh reportedly jockeying for the position. Now, looking at the 10-year, we are down slightly below 4.4%. We were above that level yesterday. So perhaps some more buying here on the back of some of those decent tariff headlines. And when Fed's benchmark interest rate doesn't primarily affect longer term rates like here and the 30-year. It's concentrated on those shorter term interest rates. But still, whatever the Fed decides does influence those longer term yields indirectly through expectations around inflation, on growth, and broader market dynamics. So it's still important to keep an eye on yields and their response to some of these Fed decisions that we could see later this summer and even into the fall here, Julie.
Allie, thanks. Well, stocks are rising as investors await developments on tariff rates, potential trade deals. Joining us now, Daniel Morris, BNP Paribas Asset Management Chief Market Strategist. And Kevin Gordon is still with us as well. As we continue this waiting pattern, Daniel, there, of course, has been this whole narrative of international stocks and a rotation into them that we have seen thus far this year. Is that still the playbook here? And investors, if they've missed that move, is it too late to get into the international stocks?
Well, I think it depends on what's your starting point. So if you're a U.S. investor considering investing abroad versus a European investor based in London, looking at your allocations, I think it probably is a bit different. From a non-U.S. investor point of view, particularly after the election, there was that consensus trade. Everyone was optimistic about the outlook for U.S. equities. A lot of foreign investors were very much overweight U.S. equities. And when things didn't quite go to plan, when we had the Liberation Day announcement, from their point of view, it did make sense to perhaps take some of the allocations that they had to the U.S. and put it elsewhere. Now, the dilemma for a U.S.-based investor is what they think is going to happen with the dollar. Now, if they invest abroad and the dollar does continue to appreciate, that adds to the total return. So from that point of view, if that's your expectation, actually increasing your non-U.S. allocations might make sense.
And Dan, I'm also really curious, as an American based in London who deals with a lot of international investors, I'm always curious to get some perspective on what your international clients, what their perspective is on everything that's going on in terms of these trade negotiations.
Well, I think I mentioned it's not terribly different as what you experienced in the U.S. There's a wide range of views on how this is all going to play out. So I think it really depends on how any particular investor anticipates this is going to evolve. And I think we all appreciate we don't have a whole lot of clarity on that. Nonetheless, I think what we've seen, if you look at fund flows, even though, say, immediately after the Liberation Day announcements in April, you did see, for example, European investors pulling out of U.S. ETFs, so ETFs that were investing in U.S. assets, that's turned around. So at least from a fund flow point of view, you actually do still see, again, European investors going back into U.S. assets.
Kevin, I want to bring you into this as well, because I'm curious to get your take on that sort of international versus U.S. situation.
Yeah, I'd be curious to know, Daniel, just if we're looking at Europe in particular, so much focus has been, rightly so, I would say, from a fiscal stimulus perspective, Germany, and that's a lot of that's been reflected in terms of the performance of the DAX this year versus even other parts of Europe. If you look at France in particular, that differential is pretty wide. But even if you look outside of kind of core Europe and you look on the periphery and where there's a little bit more of a services bias, how are you thinking about markets responding to that potential of a strengthening of domestic demand, domestic for Europe broadly versus the U.S., where supply shocks here may hit a little bit harder versus in Europe?
Well, there's two key drivers that you've seen in European equities. So you're right to point out that there's been pretty significant change in sentiment towards European equities, but I think we need to go a bit deeper and think about what those drivers are and then how you actually tap into it. So on one hand, you mentioned the stimulus coming from Germany for infrastructure, expending a significant increase in defense spending across the EU. And you do see that benefit, particularly within stocks, say, in the industrial sector more broadly. So that does seem to be a sustainable theme. Also, so far this year, a big driver for the performance of European equities have been financials, banks, reflecting the cuts that the ECB has been putting through at the same time that the Fed is not. So that arguably is a shorter term dynamic if the Fed itself actually starts to cut rates. If you look outside of those two sectors, though, the picture is a bit more mixed. I think there's still concerns about the medium-term outlook for European growth, questions about regulation, labor market supply. Go back to this expectation to increase infrastructure spending in Germany. Fantastic. Germany's really struggling with finding workers to do the job, to build more bridges, to lay down new rail. So I think it's a mixed picture. It's really a question of trying to find how you take advantage of that stimulus and pick the opportunities maybe more narrowly than just a broad European equity allocation.
Well, and Dan, something else that you've written about recently that I think is really interesting is we focus a lot on large cap tech here in the U.S. It's outperformance, it's exposure in the major averages. But as you point out, in emerging markets, it's even higher weighted in some cases. And you're looking at that phenomenon. What's sort of your conclusion? Is that a good place for investors to be looking for tech exposure also?
Well, it's just a way to think about what's driving the performance with any particular region. So as you were talking about earlier, NASDAQ, as we know, Mag 7 and so on has been a key driver for the performance of U.S. equities, this year, last year. That's a theme we're quite aware of. But you see a similar phenomenon when you look at emerging market equities, that what's driven a big part of the performance, certainly recently, but over a longer period of time as well. It has been similar types of stocks within tech sector, within communication services, interactive media, and so on, similar to what you have with the NASDAQ. So even if though we're not quite so used to looking at it that way, because you don't have a NASDAQ index, if you will, for emerging markets, the underlying dynamic is actually quite similar.
And so would emerging markets be a place that you would be recommending for investors right now?
Where neutral and emerging markets are overweight within equities is currently the NASDAQ, but it is certainly something we're thinking about and keeping our eye on.
Gotcha. Daniel, thank you so much. Appreciate it. Kevin, of course, is going to stick around. And we got more markets action coming up. You're watching Market Catalyst. Samsung is debuting its newest foldable phones at its Galaxy Unpacked event in New York City. Yahoo Finance tech editor Dan Halley, he's there. He's live on the ground at the event with the details. So what makes this one different?
Yeah, Julia, this is the Z Fold 7 and the Z Flip 7. And, 7, so you figure, all right, well, what's the big deal? Well, the big deal here is that Samsung has made a phone so thin, it's barely bigger than the USB-C port that charges it from the bottom. That's the Fold 7 basically is what allows you to get such a thin design when you're opening it and when it's closed. And so that means it's much more like a standard smartphone. The front screen is also a little bit wider. So you're really now able to get that kind of candy bar style phone. And then opening up and down, there's an 8-inch screen that you can use if you want to, do some work with Excel or PowerPoint, or you're not a nerd and you want to watch Netflix or something like that. And they also have the Flip. That's what you're seeing there. That's the Z Flip 7. Now, big deal with that. It's also been designed to be a little bit lighter and it has a larger front screen. You can see there, it takes up the entire cover now, and a larger inside screen. So that guy is, the way I put it is, the Fold is kind of like the workaholic. The Flip is kind of like the party animal. That's where you're going to take all your selfies and have a lot of fun. And then, like I said, on the Fold, you're going to kind of nerd out a little bit and do your spreadsheets, or maybe not, and just watch a whole bunch of streaming stuff.
And Dan, I wanted to bring up Apple as well, because obviously Samsung's been sort of ahead of the pack in terms of some of these product introductions. Apple, meantime, as we know, is dealing with some internal movement, so to speak. It's announcing that its COO, Jeff Williams, he's going to retire later this year, and the company's current senior VP of operations will take over that role of part of what Apple's calling a long-planned succession later this month. Williams is going to continue reporting to CEO Tim Cook. He's going to oversee the firm's design team, Apple Watch, health initiatives. So he was seen as a contender potentially for Tim Cook's job. So what does this tell us about what's going on inside Apple succession-wise?
Yeah, I mean, look, they're still trying to figure it out, I think, right? We kind of had this larger industry line of thinking that Jeff Williams was, the next person, although he's not much younger than Tim Cook. So it kind of, it was like, okay, well, if he does come in, how long is he going to be able to stick around? Now, obviously, with him retiring, he's going to be, as you said, staying on to kind of lead design and the watch and things like that for a period, but not, permanently. So the question then becomes, okay, who succeeds Tim Cook? And it's not as though Tim Cook has to, pack his bags and get out the door or anything along those lines. No, it's just that they need to have a plan for who's next. And there are a number of executives that have been bandied about. If I had to guess, it's going to be coming from Apple internally. They have a very strong internal culture. And so that'll be probably the biggest, most important piece is, do investors know who this person is? Do they know the company itself inside and out? And will they be able to be the kind of leader that it needs in these kind of tumultuous times that the company is dealing with?
Yeah, lots of questions and good ones, Dan. Appreciate it. Let's talk more about the tech trade. We talked earlier about Nvidia, $4 trillion, but it's worth pointing out that when we look at large cap tech, stocks like Apple have not really performed, right? The stock is down pretty sharply year to date. Kevin Gordon's still with me here. So you talked earlier about the idea that it's not just this sort of Mag 7 bullet train that is dragging the rest of the market. And indeed, even within the Mag 7, Apple's not done great. Amazon's sort of meh. Tesla, don't get us started on that one. So, so there is now this differentiation. How do investors need to think about if they want to be in growth, if they want to be in large cap tech? How should they be thinking about it?
I actually think it's a better setup for investors, especially for the retail investor who has thought for so many years and almost been tricked into thinking, because of that dominance of the Mag 7 trade, who has been sort of tricked into thinking that those are the only names or the only games in town. And you look at the performance, even not just Apple, but you mentioned a couple of other names in the Mag 7 group. It's hard to even consider it really just a bullet train, one bullet train, because there's only 3 companies in the Mag 7 that are outperforming the S&P this year, and the split between those 3 and the rest and the bottom 4 is pretty significant. And I find it interesting, even in that top 3, you've got Microsoft in there, which is in the same sector as Apple, housed in the same sector, but totally opposite performance versus Apple, which what you've seen year to date. So I think the fragmentation of that group has been a really notable theme over the past, and it's not just a year-to-date phenomenon. You could date it back almost to to last summer. But I think that's been a really interesting sort of thematic development in the market, because I think it's been maybe part and parcel of what has become, I would argue, a better diversification environment for most investors, especially when you look at sector performance. I know I mentioned earlier kind of this dominance and leadership that you've seen for industrials and financials. The fact that that's happening even as tech is now getting up and running again, I think that's a healthier backdrop, because it shows you that the gains don't have to be always just concentrated in a handful of names.
Yeah, we kept talking about where's the broadening. Yeah. Now we're seeing
we see it.
The broadening, even as stocks are near record highs. Yeah. All right, Kevin's going to stick around, and coming up, 2 of the biggest trends in what's shaping up to be another record year for ETFs. ETFs saw over $1.1 trillion in total inflows in 2024. That was a record-breaking year. So far in 2025, they're on pace to exceed that. And my next guest says there were a few trends in June that could give a hint about where the rest of the year could go. I want to bring in Todd Rosenbluth, TMX VettaFi Head of Research, for this week's ETF report brought to you by Invesco QQQ. Hey, Todd, it's great to see you here. So obviously the ETF business is an unstoppable machine and trend. In June, what really stands out about where fund flows were going? What kinds of developments did you see?
So there's 2 areas that we focused on in some recent commentary. One was actively managed ETFs. The second was fixed income ETFs in general. So for the year, actively managed ETFs have gathered roughly 40% of the new money in 2025 in the first half of the year. They are roughly 10% of the overall asset base. So punching above their weight, we've seen strong interest for actively managed ETFs in both the core part of the products as well as offering additional income. And so we're really excited to see that growing demand, low-cost products that have come to market from T. Rowe Price and Fidelity among those firms. That's really caught our eye.
I'm always curious about this, Todd, particularly in the ETF business, if it's a push or a pull. In other words, ETF providers are very good at coming up with lots of different creative, obscure in some cases, new products, right? And I'm always curious if it's because there's demand for them or if it's because they want to sell more ETFs, right? So what are we seeing in this case?
So we are seeing a growing supply of ETFs that are more complicated, that are trying to solve a problem, but that it's a more complicated problem. So we've seen a growing number of options-based ETFs and other ways to generate income using the ETF wrapper. So Calamos, for example, launched a suite or auto callable ETF recently. We've seen Innovator bring some products to market that are new, that are providing different level of downside protection. But yet we are also seeing new products come to market that are fitting in with the broader theme. So Vanguard, they don't launch too many products. Vanguard today launched 3 fixed income ETFs. We've seen Vanguard increasingly embrace actively managed ETFs that I was touching on earlier. They launched an active ETF as well as 2 index-based products today. We're really excited about what Vanguard has been doing within the fixed income ETF universe.
Well, and let's talk about fixed income more broadly, because that has really become a juggernaut, of course, within ETFs, and the growth that we've seen there has been pretty incredible as well. And I know you guys have done some work and some survey work on sort of subsectors within fixed income ETFs and where they have been popular. So what have you been finding out?
You're right. So at VettaFi, we recently had a symposium where we asked advisors where their focus was for the second half of the year in fixed income. And so investment grade corporate bonds tend to be relatively popular. We saw interest in that. We saw interest in short-term treasuries. And then municipal bond ETFs. That continues to catch my eye when we see strong demand for the sleepy part of the fixed income marketplace. But we've seen success. We've seen Vanguard have success with their product, their low-cost diversified product. And we've seen increasingly firms bring actively managed municipal bond fixed income ETFs to market. Goldman Sachs is a name that comes to mind. They've launched active municipal bond products that's caught our eye and starting to garner some interest.
So, Todd, all of this said, what are you watching in the second half of the year? What are you going to be paying most attention to?
So I think we're on pace for another record year. We're going to cross $1 trillion in overall ETF flows. That certainly seems to be the pace. You showed the numbers earlier. We're likely to pass $300 billion again for the fixed income ETF universe. We're at about $185 billion at the mid-year point. So we're excited to see what's happening in both the active space and fixed income. And there continues to be innovation within the index world as well. We've got some exciting products that we're seeing tied to our VettaFi indices that are likely to launch later on in July.
And Todd, whenever I talk to you about this stuff, I like to take a step back. Where are we in the ETF industry in terms of size versus the traditional mutual fund industry? How is it now stacking up?
Yeah, so mutual funds are still considerably larger than the ETF space, but the gap has been narrowing. So mutual funds continue to see net outflows industry-wide. We continue to see net and record inflows for ETFs industry-wide, but the lines are blurring. I mentioned Fidelity and T. Rowe Price. Those are 2 of the leading firms within the mutual fund world. Capital Group, another firm that's known for their American funds. All of these firms are increasingly putting their focus onto the ETF space. So we're seeing some of that money move from mutual funds to ETFs. That's a great thing for investors. That's a great thing for advisors that are working with them.
Todd, great to see you. Thanks for joining us.
Thank you.
Coming up, we got much more on Nvidia's $4 trillion market cap milestone in the second hour of Market Catalyst, as well as the latest rhetoric from President Trump on the Fed. We'll be right back. We are 90 minutes into the start of U.S. trading. I'm Julie Hyman. And the top market story today, Nvidia, crossing the $4 trillion market cap milestone. The first company gets to that level. The shares are at a record. And taking a look at the broader markets, really Nvidia is sort of having a halo effect, or it was for the NASDAQ. Actually, the NASDAQ was up more than 1% the last time we checked on it. Now it is just up 0.4%. So really we've seen a come down from the highs of the session here, which has been interesting. Taking a look at the bond market as well, we did have President Trump coming out on social media once again attacking the Federal Reserve and Jay Powell and saying he's looking for a 300 basis point reduction in interest rates. So we are seeing that reflected to some extent in what's going on in the bond market with yields pulling back. Coming up this hour on Market Catalyst, first up, Nvidia becomes the first company to reach a $4 trillion valuation. What comes next for the AI chip giant? We'll have full coverage. Plus, the future of the Fed in focus amid new reports that Kevin Hassett could be a front runner for the job to head up the central bank. We'll discuss the rate implications. And Circle getting a downgrade on Wall Street after soaring since its IPO. We'll discuss that and more on Market Catalysts. We do have some breaking news now. The CEO of Elon Musk's X social platform is stepping down. That's Linda Yaccarino. She says she is immensely grateful to Musk for entrusting her with the, quote, responsibility of protecting free speech, turning the company around, and transforming X into the everything app. Yaccarino was appointed CEO in May of 2023. Joining us now, our executive editor, Brian Suzzi, who just spoke to Linda Yaccarino recently in Cannes. Right?
I hope it wasn't me.
Did she give you any tip-offs that this was coming, Seth?
No, but I'll put some context on this.
Yes,
I think
please.
In talking to Linda off camera and then of course on camera, you really got the sense that this job has taken some form of toll. I mean, this has been not your normal CEO job. Now, I will say this though, Linda Yaccarino is absolutely tough as nails. You want somebody negotiating a contract, you're putting Linda Yaccarino in there. But I think at the end of the day, and like she hinted to on her post, this is going to be a different company compared to 2 years ago when she arrived. 2 years ago when she arrived, her main task was to take her experience at, I believe it was NBC Universal and advertising industry and get the program or get the platform back to where it needed to be on ad revenue. While it may not be back to where it was before Elon Musk took over the platform, she has gotten a lot of ad deals back and a lot of ad deals back on the X platform. Check done. Now it is X, I think, is entering its next lifespan. Of course, that merger with XAI, but then of course a push into something called X Money. I asked Linda about that. Here's what she said.
The historic turnaround has been just an incredibly joyful thing to an experience and an incredible outcome to our team at X. Imagine the day-to-day jobs, putting the noise out, keeping your head down, doing the work, and now what's been happening under everybody's nose, now they're starting to see it. Oh my God, they meant what they said, and they came and delivered the Everything app. So that's what's been so fulfilling, and I'm happy for the team.
So you would do it all over again?
In a minute.
Just literally spending that amount of time with her, again, on and off camera and sitting right where we're sitting here, I didn't get the sense that this was her swan song. I mean, she was there for a long period of time at Cannes. It's a very busy event, ton of meetings. I believe I was her only interview on camera, but this is not about me. I just didn't get a sense that, this was her swan song. I think she was in the trenches still trying to do what she needed to do at X. Unclear who's taking over the company, or is it just Elon is just regaining control? And now, look, X is a different platform. If you're going to put payments on this platform, you essentially have a modernized version of PayPal, which of course Elon helped create, except now you have conversations and you're going to have commerce. And that is a different business model than Linda signed up for.
Well, and it's also got a lot more competition than when PayPal was sort of pioneering that industry and when Elon Musk was involved with that company. As an aside, joyful, the word she used, and X are not usually two words that I think of together from a user experience perspective, but that's a whole other conversation. What I also think is so interesting here is that this is at a time when Tesla shareholders are not terribly happy with Elon Musk because of his split attention in the political realm and this start of the America Party, right? And so is he going to be doing that? And if he is indeed going to be now helming X on his own, you have to wonder what shareholders in some of his other companies, how they're going to feel about that.
You don't want to see, I think, Elon trying to lead this business also. So far be it for me to tell Elon what he needs, and maybe he has a person in mind.
You don't want him to tell you to shut up.
Like Dan Ives, right? Well, actually, I wouldn't mind. It's fine. Whatever. It just rolls off my back. But at the end of the day, I think it's clear he needs some form of product person. Now, Elon views himself as a product person, but he can't be running all these businesses at the same time. I also found it interesting. I asked Linda at the time, is X profitable? She didn't say X was profitable because I was trying to get the sense at some point, do they bring X back to public markets to drive the value or more value out of the business? Unclear to me.
Yeah, it doesn't seem like there's been many murmurings of that. Interesting.
Thank you
so much. It remains so. Another breaking news that we are following, thank you, Sal, sorry. Another breaking news we're following, there's so much going on. Nvidia making history this morning as the first public company to reach a $4 trillion market cap. We're joined now by Stacey Raskin, Bernstein Managing Director and Senior Analyst to talk about this milestone. Still with me as well, Kevin Gordon, Charles Schwab Director and Senior Investment Strategist. Stacey, thanks for hopping on to talk about this. Whenever I think about Nvidia and chips, you're the guy that I want to come to and get some perspective.
I appreciate that. Thank you.
Yeah. So, I mean, was this feels inevitable? Do you think it was sort of inevitable that we get to this $4 trillion level? And what do you think is responsible for the latest leg in Nvidia?
Yeah. Look, in the markets, nothing is truly inevitable. Maybe now that being said, look, AI is probably one of the largest like technological inflections like in our lifetime and probably in history, and they're like right at ground zero creating it. And so if that is going to be as big as I think many and myself think it can be, why shouldn't they be benefiting from it? I mean, they should be presumably benefiting from it more than anybody else, and clearly they are. So in that sense, I would like to think that it could have got here, and it did, and I'd like to think that this is not the end as well.
Well, and one of the things that some investors have talked about is the valuation of Nvidia. Even as it has climbed and climbed, though, the PE has not gone crazy because the company keeps earning more money. At what point, would valuation look stretched? Are we anywhere close to that yet?
Well, versus its history, clearly not. I've seen it trade, as high as 60 times earnings, and this has sort of been a controversy the whole time. I remember, before this started, it was expensive. It was actually more expensive than it is now, and just as the stock itself was running up, a lot of people used to make the point about valuation, but they were sort of conflating valuation with market cap. And I made the point time and time again, I may have even made it here, that to the extent that the stock price had gone up, the earnings had gone up even more, and the multiple had actually come down. And if you look among all the AI stocks, quote unquote, right now within semis, it's probably one of the cheaper ones now, as long as you believe that the numbers are achievable. At this point, like they look pretty achievable. Yeah, the valuation looks pretty good to me.
And it's funny, Stacey, because we're talking a day after you caught my eye with the note that you came out with that said, U.S. semiconductors, time to awaken from tariff slumber.
Yes. Is
that the big stumbling block for Nvidia and its competitors?
Well, maybe less so. So tariffs in general, people, the whole sector, not just in semis, but everything kind of got whacked in April during Liberation Day. And with all the back and forth and pauses and everything, people have sort of, dismissed tariffs, I think, as a risk. They clearly must be, because the markets broadly are at record highs. And, Trump sent out some tariff letters a couple of days ago that were mostly consistent with the reciprocal rates that he talked about before. And it looks like those rates may come back on August 1st. And within semis in particular, we have the 232 investigation that's going on. And my assumption is that we actually will see tariffs specifically on semiconductors at some point, probably soon. And it is something that I do think investors have not really been looking at. So it's something that should be. Now, as far as that goes, the AI space actually may be a little bit more insulated. Number one, just because the demand, I think, is actually quite real. But in terms of the tariff structures themselves, most of the AI servers that are used in the U.S., it turns out they actually come in through Mexico. And there's another broader carve out with this. Stuff that comes through Mexico that's USMCA compliant, which these servers actually have no tariffs on them at all. So I think like tariffs, nobody's completely insulated if it actually gets implemented. But I actually think the AI supply chain, in some sense, may be somewhat more relatively insulated than other areas of the space because of that Mexico avenue and some other things. Plus, like I said, I think the demand in general is off the charts. If costs go up, I think spending still happens.
Yeah, Stacey, I was going to ask, separate from, 232 and what happens with those investigations, if you just look at what's being proposed now in terms of countries, and we'll find out whether, August 1st is a firm deadline. But beyond that, or in addition to that, I think one of the interesting things that's come out recently, especially with all the letters that have gone out so far this week, is this focus from the administration on transshipments from China.
Yes.
Whether there's an enforcement mechanism, I think that remains to be seen, and how well that can be enforced. But how are you thinking about that, in terms of risk, whether it's from China or from, certain Southeast Asian countries that are then caught up in a little bit of this predicament, rock and a hard place between the U.S. and China?
Yeah, it is true. And so they are trying to block transshipment. So what the letters said, basically, if we've got higher, I'll make an example. If we've got higher tariffs on stuff from China, you're buying stuff from China into Korea and then shipping it out, it's going to be charged a tariff at the higher rate, right? They don't want to be able to use transshipments through other countries to try to block off China or other countries like that. So that is a risk. Now, how they would actually track that and the administrative and logistical overhead that would be required to actually track and enforce something like that, I don't know. And I actually don't know that the capability to do that among these companies actually exists right now. So there's a whole other debate that this probably like we could have at some point on that. I don't know how they will enforce it. But clearly, you know, like the Trump administration is trying to carve off China from the rest of the world. And in some sense, they may be setting the countries who play in both markets against each other, because things that the U.S. wants to do, I mean, China's going to want the opposite. And, you know, in some sense, a lot of these countries will, or a lot of these companies will be between a rock and a hard place. I don't exactly know how this is going to be dealt with as this stuff finally gets implemented, if it in fact it does get implemented. I don't know.
So all of this notwithstanding, Stacey, we know that you still like Nvidia, and we've talked to you before about other semi stocks within the universe that you like. But just to remind viewers, you know, you're a buy on Nvidia. What are the other places where you still see upside and opportunities, especially given, as you said, Nvidia actually looks pretty fairly valued even versus some of its competitors?
Yeah, so I you know, in our specific coverage, I like the AI names. I like Nvidia and Broadcom. I think tactically, if I had to pick one over the other, we like them both. I'd probably lean a little more towards Nvidia just because it is cheaper, and I think they've got pretty smooth sailing, I think, through the end of the year. Like again, the Blackwell supply for them has kind of opened up, and they've zeroed out China. You know, there are sanctions on what they can sell into China. They've zeroed it out. So to the extent that they can work around those at all, if they can, that would represent upside. Broadcom has a lot of AI upside as well. It mostly comes next year. So that starts to get attractive. I'd be looking at that one on dips at least. I also like Qualcomm. I seem to be the only one that likes Qualcomm. The issue with Qualcomm, there's no real catalyst, and like earnings doesn't really grow because, you know, they sell stuff to Apple and Apple's designing them out. Like this is totally known, but it does limit the EPS growth for the next few years. But I actually think under the surface, things are looking really good there. And, you know, you get to 2027, maybe when Apple is kind of out of the model, some of that goodness starts to really show. And the stock is very, very cheap. So I think it's at least worth sharpening pencils on. I'm mostly lukewarm on most of the rest of the space. Like my analog coverage, they're very expensive. They're actually seeing some upside, I think, near term. Most of them are calling for a cyclical bottom, which maybe, although that would also look the same as tariff-related pull forward. And I'm of the belief that we probably are seeing some pull forward. Again, my names are fairly expensive in the analog space. We've been a little lukewarm there. AMD have been lukewarm as well, although I kind of understand why that stock has been running, because, you know, the big story for AMD is the MI450, which comes next year. It's not for a year. You can dream right now. That number can be as big as you want. We saw the same thing last year around this time when people were thinking how big the MI300 for them could be in 2024. It turned out not to be as big as people thought. But for a while, the stock really worked, and we're seeing similar dynamics now. The other one in my coverage is Intel. Intel's kind of a basket case. Like I'm kind of, I always joke, I've made my career being negative on Intel. I'm kind of afraid to short it. We're neutral on the stock, right? Because, I mean, it's sort of just like event-driven and headline-driven, but it doesn't feel like a long to me either. It's going to be a slog. Call me in a few years on that one.
Yeah, it's hard to find the Intel bulls, even after all that has happened, Stacey. It is great to see you. Thanks again for hopping on.
Yeah, you bet. My pleasure.
Of course, Kevin's going to stick around. And coming up, President Trump continuing his calls for a rate cut from the Federal Reserve. We'll take a look at the top contenders to succeed, Jay Powell, and the effect on the market. That's next. President Trump calling again on Wednesday for the Fed to lower rates, claiming the current range is at least 3 points too high. The calls coming as the battle for the next Fed chair has narrowed to a Kevin versus Kevin showdown. At least that's according to the Wall Street Journal. Trump's economic advisor, Kevin Hassett, emerging as a serious contender to be the next Fed chair, threatening former Fed Governor Kevin Warsh, who was an early favorite for the job. Regardless of who's named as Powell's successor, the expectations are clear. President Trump wants the next Fed chair to cut rates right away. Here to discuss, Ben Emmons, FedWatch Advisors founder and chief investment officer, and still with me, Kevin Gordon, Charles Schwab director and senior investment strategist. Ben, you are a longtime Fed watcher. So I guess let's first of all get to what the president said on social media. I think this might be the first time he keeps saying he wants the Fed to cut rates. I think this is the first time he's given a specific number by how much. I mean, is any of this realistic that the Fed is going to be cutting rates that quickly and by that much?
No, it's not. Obviously, on this current FOMC, he actually did indicate first 1% and 2%, now it's 3%. So it's kind of goalpost idea. But you're right that it becomes more and more specific. So it's really about this next Fed chair being essentially charged with, like, that is your goal to bring rates down by that much. The market pricing is obviously not there. There's about 100 basis points priced in up until by the time that Powell leaves the chair position next year. So market doesn't really respond to this, obviously, until he does announce the new chair, the Kevin moment, right? That may be the case. I think still that it's about, like, it's ultimately the FOMC that makes this decision. And that was really interesting about Secretary Bessent this weekend on one of the newswires. He was specifically asked, like, if you become the Fed chair and the president asks you to cut rates, would you do that? And then he paired back saying, like, well, it's a committee decision. So I think to this point of that, yes, you could say lower rates by 300 basis points, but it's ultimately the committee. And I think for this year, it will be just maybe 1 or 2 cuts that will be delivered if inflation cooperates, not 300 basis points of cuts.
I mean, I have to say, Ben, I was really struck by the tone of the Journal article that talks about the two Kevins. It basically mapped out their changing opinions as stated publicly on these issues, particularly with Hassett. They said about Hassett, he spent the last 8 years in Trump's orbit learning to adapt his positions to the president's instincts. Not a terribly flattering portrayal of him or of Warsh, for that matter, in terms of how they have changed. And do you run the risk of, if either of these men is appointed, having a total disconnect between the markets and the Fed? Even if the Fed is setting interest rate policy, if the markets don't see them as an independent body?
And that's very true. And we've had disconnects before like that, but that would be the extreme disconnect. Because it is interesting to read that, because Kevin Hassett actually was strong on Fed independence. That's he's been putting that out there.
Was being the operative word
right,
there,
so
yeah.
Shifted, right? And same with Kevin Warsh. He was a strong opponent of quantitative easing, and now he's shifted his tone too. And Michelle Bowman was actually the only FOMC member recently making a case for a hike if inflation was going to go up, and she shifted to rate cut. So it's interesting how this influence is coming through, and that at least the officials are listening, but the market may not. It may be not the case. And that's the tension that we could see in the future, that you're getting actually market pricing saying, like, you can't really cut rates here because of the economy being too strong, that there will be ramifications for markets, I think particularly for the dollar, because we've seen this weakness of the dollar coming through on tariffs and on, I guess, rate cut speculation. If the market prices it differently than what Kevin Hassett is going to do, wants to do, the dollar could actually strengthen as a result.
I mean, Kevin, I want to get your take too on the, speaking of another Kevin,
I was gonna say,
the better,
call
the
me
best,
Gordon.
the best Kevin of the three, clearly.
Needless to say, neither Warsh nor Hassett is me.
So when we talk about the effect on the equity market, I mean, we've been talking for the whole show about how the equity market has been so resilient in the face of tariffs. But it's also been pretty resilient in the at first, when President Trump was talking about removing Powell, the equity market didn't like that. But now it's just another day.
Yeah, well, I think to the point about, and I'm glad that you brought up sort of the difference between the chair's view, but also the rest of the committee. You know, you'd have to go against 11 members, you know, to really, if you're going to argue for cutting by, you know, a couple hundred basis points, that probably wouldn't sit well with the rest of the committee in today's time. I mean, I think what is often lost in this conversation is by the time we get to May, the economy can be in a totally different spot. It could be in a spot where rate cuts are certainly not warranted if you see inflation pressures kick back in, whether it's because of tariffs or whether it's because we've seen, you know, a pretty significant rebound in the economy where you see some kind of healthier, maybe pro-cyclical inflation. But that aside, I think from the market standpoint, I do think there's, you know, over time, as you get adjusted to some of the rhetoric that is coming out from the White House, I think there's a realization that it's not just the Fed chair making policy, and also that, you know, whether it's from a Supreme Court standpoint of what has been said so far this year and some of the rulings around, you know, the Fed being a little bit of a different body in terms of how protected the chair is from a potential, you know, firing effort from the White House, or whether there's just this sort of recognition that the economy is in a generally healthy spot and doesn't necessarily need rate cuts right now or of that magnitude. I think that's probably what the market's been keying off of.
Right. I mean, and to your point, even if there is this replacement made, it doesn't automatically mean the Fed is going to cut, because it is a body of more than one person.
Yeah, very likely. I think if today's FOMC minutes, you'll see this debate as usual, camps in there, and we know the position of both Waller and Bowman now, that they think July could be a rate cut, so that's in there today. That expectation has been really strongly pared back after last week's payroll report coming out stronger. So the market very much understands that the only way the Fed could cut rates faster if we're getting a materially weaker unemployment, and that's not happening, as you say. Like the economy seems to have traction, and think of this too, that the president has a big list of companies and countries investing in the US. He's very likely going to go after these countries and companies to actually do it. Think of that say maybe 20% of that gets materialized. So there's a few $1 trillion of investment in the United States economy. The economy will be on fire. So the Fed will not be in a position of cutting rates in that scenario either. In fact, if anything, long-term interest rates are likely going to rise even more if that actually happens. So it's a real interesting scenario going into this chair announcement.
At the same time, I do want to linger on employment in the job market for just a minute, because Kevin, I know that you've been watching some of those underlying labor market statistics, and you're not the only one. You know, we've seen some economists who are saying there are a couple of warning signs.
Yeah, it's just worth watching. I think the move up that you've seen in continuing claims, the compression and the rehiring rate. It still tells you that we're in this low hiring, low firing environment that we've been in for a good chunk of this cycle. I mean, you look at even the unemployment rate staying stable, relatively stable over the past couple of years. That's extremely unique and sort of unheard of to see in a cycle. Typically, the unemployment rate is falling or it's moving up. It's either moving up exponentially or it's falling gradually over time as you go throughout an expansion. It's very rare to see the move that we have seen over the past year. So I think that, that aside though, there are stress sort of fractures where if you apply enough pressure from a tariff standpoint, from a labor policy standpoint, which I think matters a lot more in terms of immigration policy, there are enough stress points where you could eventually weaken the economy enough to maybe go into a mild recession. I think you'd need an extreme negative catalyst to push you at this point into a deep recession, which could be trade related or immigration related, if you see deportations pick up enough or if you see immigration really stall out. But right now, you're just kind of moving into that slower growth environment where it's not necessarily causing a significant spike in unemployment across all sectors. It's just happening sort of almost on a rolling basis.
And what do you think labor market-wise? It sounds like you see things more as stimulative, but it sounds like than what Kevin is saying.
Yeah, I do echo his point, like this weakness in the labor market, certain areas. But it's just not broad enough to get to this 300 basis point rate cut cycle that quickly. That's clear, right? I think that, and the market understands the Fed's reaction function. Like if it does get really weak, then yes, those rate cuts are very justified. So it's more about inflation. For some of the Fed members to say, well, inflation is here and the Fed funds rate is here, so we can cut that rate a little bit. But the moment you start investing in the economy, and think of the cycle that we went through from 2022 into 24 of the CHIPS Act, the Infrastructure Act, those had actual impact on trendline growth.
Right.
We were running like 3% average growth. If I think of trillions are coming into the economy, and it's not impossible that actually happens, we're not talking about 3, we're talking potentially about 5% economy. There's not a Fed funds rate that can be at 3, 4, or 2% in that scenario. Right. And so this is the tension, especially if the investment cycle leads to more employment for that matter. Right. So this Fed is very much in a neutral zone today, and you always have a debate about somebody wants to cut rates sooner rather than later. But at the end of the day, the FOMC determines the decision and seems to be very in neutral stage, keeping rates where it is.
Ben, thank you. Good to see you. Appreciate it. Well, the Allen Company Conference kicking off in Sun Valley, Idaho, where the top-ranking media and technology executives descend on the quiet town for discussions, deal-making, and more. Yahoo Finance's Ali Canal has more. So, Ali, what have we been seeing so far? What can we expect from this year's event?
Well, it's a summer camp for billionaires, Julie, right? As you were just saying, this is the site for a lot of deal making for tech media companies. And already we've seen the arrival of some pretty star-studded names. Sam Altman from OpenAI, for example, he was among those early arrivals. I'm sure there will be some interesting meetings there after Meta CEO Mark Zuckerberg tried to poach some of that AI talent, perhaps this budding rivalry over in Idaho. We also saw the arrivals of Apple CEO Tim Cook, former Meta COO Sheryl Sandberg, Bob Iger from Disney, Andrew Jassy from Amazon. So a lot of these high-profile names within tech and media. Now, in terms of deals, I am focused on Warner Brothers Discovery. Earlier today, we saw the rebrand, I guess you could say, of HBO Max. Remember HBO Max? That was the original name of the streaming service. Then they rebranded to Max, and now we are back to the OG HBO Max. And this comes after Warner Brothers Discovery said that they will be splitting up their company into two separate publicly traded entities, one focused on studios and streaming, and the other focused on linear networks. Now, the big question at Sun Valley is who will be a buyer of these declining linear networks? Perhaps CEO David Zaslav will make his pitch there. I also think there's going to be a big focus on the role of artificial intelligence, how businesses are using that in their everyday workflows, how that's improved productivity. There's certainly a lot of potential deals that could be made on that front. Another area of focus is also going to be Trump 2.0. How have these various policy shakeups impacted the thinking of these executives and what we still have yet to see, especially when it comes to deregulation? So a lot to keep track of. This conference, always buzzy, and I'm sure we're going to see more news trickle through over the next week.
We'll be looking for it, Allie. Thank you. Got much more markets action coming up. You're watching Market Catalysts. Now time for some of today's trending tickers. We're watching Alphabet, Bloom Energy, and United Health Group. First up, Alphabet shares are rising as Google announces it's rolling out its Gemini AI assistant for smartwatches, with the Samsung Galaxy Watch 8 getting the technology first. It'll roll out to other watches in the coming weeks. The wearable version of Gemini supports voice interactions. It can create tasks and offer a more enhanced experience than Google Assistant. The news coming out of Samsung's Galaxy Unpacked event. We talked to our Dan Halley, of course, earlier at that event, and those Alphabet shares are rising in today's session, along with a lot of other large cap tech stocks that we have been seeing move higher. I guess Kevin Gordon, who's still with me here, I guess Alphabet's one of the few that we haven't hit on yet when we're talking about large cap technology. Certainly Alphabet has been holding its own, but it's not been an outperformer within large cap tech, which speaks to our theme earlier of things sort of now not all moving together.
Yeah, it even within a sector, this is actually a good case of sort of the fragmentation that we've been talking about so far this morning. Alphabet and Meta are the two largest stocks in communication services, and actually if you combine them, you're looking at more than 70% of the market cap of that sector. So actually the ultimate concentration risk is really within that sector, but it speaks to how you've seen almost mirror-like performance for those two, at least year to date, where Alphabet's been struggling more than Meta. Not that I cover the stocks, but I think looking at that, kind of using that almost as a case study of how there has been this fragmenting, even within the two largest names. Clearly, there have been more idiosyncratic things at play, but I think that's, again, part of the broader story for the mega caps. You're seeing the split in tech, you're seeing the split in communication services. Consumer discretionary, if you're going to round out kind of all the Mag 7 sectors, that is a little bit of a different story, where Amazon and Tesla, the two biggest companies, those have lagged year to date, almost in sync with each other in terms of the lack of willingness to kind of get up and going. But I think that it's probably part of a broader consumer discretionary weakness story, where a lot of those companies and industries within that sector, they just face a lot more of a tariff risk than the other two.
Right, makes sense. Let's talk about Bloom Energy as well. It's soaring on an upgrade from JP Morgan. The firm lifting its rating to overweight from neutral on a surprise tax credit. Fuel cells will qualify for the clean electricity investment credits as part of the new Trump-backed tax bill. The analyst there, Mark Strauss, writing that the tax credits could push hesitant Bloom customers over the finish line, with order activity to increase accordingly. Not for nothing, Kevin, I think it's so interesting here that the stated goal of the bill is not to create winners and losers in the energy industry or to advantage some over others, but clearly it is doing that.
Yeah, well, I think even what's more interesting, we almost use the energy sector as a bit of a case study for when it comes to investing with your political bias as an investor. Because if you look back at the first Trump administration, what did really well was sort of the renewable energy space and everything sort of green related, in terms of stock market performance. names. It was the traditional energy, sort of oil and gas, that got crushed relative to those names. It's actually energy from inauguration day to inauguration day, from Trump 1 to the end of that term. Energy was the worst performing sector, and it was also the only sector that was down. Vice versa, if you look at under the Biden administration, the narrative was that a lot of that was going to flip, where renewable would do well, where traditional energy wouldn't do well, but that clearly wasn't the case. Energy was the best, one of the best performing sectors. So it's interesting to see today, a little bit even a reversal of that dynamic, where even under Trump 2, and I wouldn't put it based on any political bias from any administration, under this sort of second round, traditional energy has been, sort of in a worse performing spot.
Yeah, well, drill baby drill is not great for oil prices on the face of it.
Especially when oil prices are down, yeah.
Yeah, exactly. And finally, United Healthcare reportedly under DOJ investigation around the insurance company's medical billing practices and how medical diagnoses are documented. That's according to the Wall Street Journal. The report says former United Health employees have been questioned by prosecutors about the company's efforts to encourage documentation of certain lucrative diagnoses. This includes testing patients, implementing procedures to make sure medical conditions were captured, and sending nurses to patients' homes. The Journal reported back in May that the Healthcare Fraud Unit was overseeing a probe of United Healthcare's Medicare business, and that investigations date back to at least last summer. Now, I know, Kevin, you can't talk about United Health specifically, but you can talk about the healthcare group more broadly. We talked earlier about how it's a traditional defensive group, and it's been, I don't know what other word to use. It's been a weird year for healthcare, right? When it comes to insurance and situations like this, when it's come to pharmaceutical tariffs, maybe, it's been sort of tough to navigate.
Whenever I talk about the healthcare sector, especially with our clients, it's such a big sector, not necessarily just in market cap terms, but you look at the different industries and how different they are from each other, whether it is insurance, whether it is pharma. Right there, you face two totally different sets of risks from a trade standpoint. But even if you include something like biotech, which tends to get swept up in really high momentum, high beta trades at times, especially in this most recent rally we've seen. Actually, what's been leading is a lot of the non-profitable companies. So that biotech tends to be sort of at the center of that trade. So even within a sector like healthcare, which has lagged a lot this year, and relative to the S&P, is still hovering near its lowest levels since 08, 09. You can find some significant outperformance at times. That doesn't necessarily mean it lasts for a long time, because I wouldn't necessarily say that the unprofitable trade is one that is a secular grower over time. But I think within a sector that's so large, that's an important thing to keep in mind.
Yeah, most definitely. And as always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up next, we're going to be talking about a darling that is a recent IPO and a downgrade that it got. We'll be right back. Circle is lower today. Mizuho yesterday initiating coverage with an underperform rating, citing the stablecoin issuer's potential downside to consensus revenue for 2027. Joining us now is the guy behind that call. That's Dan Dolev, Mizuho America's senior financial technology analyst. We always love to have you on here. And Circle has been such a hot name. I mean, that's an understatement, right? And it's not often that you and your peers in sell-side research have underperformed calls, just in general. So what warranted that? Is it because it's been such a rocket ship?
It's an amazing category, and we did a deep dive into stable coins, and the technology is great, even though part of the technology is it's a solution searching for a problem. But specifically for Circles, there's three things coming at them over the next 6 months that are not priced in, right? The most important thing is people are not pricing in rate cuts. And if you look at consensus, it's expecting 5 rate cuts, about 125 basis points between now and then. 99% of the revenue that Circle makes is basically money market interest rates. It's like buying treasuries. They're buying treasuries on your behalf. So if rates come down, that's like a 20 to 30% downside risk to revenue. The second thing is people are expecting the minting of those coins to go bananas. In reality, it's been flat. Literally since April, there's been no growth in those coins, 62 billion. And then the third and not most important thing, but one of the important things is that, you have a lot more competition coming their way. Like everyone has a stable coin. PayPal has a stable coin. Walmart wants to do a stable coin. So it's kind of a commodity.
Circle, though, like many other companies within the cryptoverse, doesn't necessarily trade on fundamentals, as we know. It trades on psychology, it trades on enthusiasm, and in this case, it had the benefit of being both hitting at the same time that the stablecoin legislation was making its way through. It was an IPO in a market that has not seen many IPOs. So, and that can go on for a while, as we have seen historically. What do you think would make investors sort of realize some of the things that you're talking about?
Yeah, so you mean the catalytic event that just kind of drags it all down. We've been thinking about this a lot on our team. So one thing that can happen, and this is maybe just thinking, is like the second Powell or his successor, I don't know, we don't know what's going to happen there. No. Takes rates down. That's the signal. People are going to realize, hey, what's going on? This business is really just like investing your money in treasuries. If treasuries come down, their revenue is gonna go down. So I think this could be a trigger to this thing. The second thing which is coming is the lockup, which is typically like 6 months. The float is very small. So if the shareholders, the founders, VCs, they want to sell shares, when the lockup expires, they're gonna have to dilute the current shareholders, and that's gonna create more pressure on the shares. So that's what we're saying. If you're thinking about the risk here, there's a lot more downside risk than upside risk because it's gone up so quickly. And to your point, detaching itself from fundamentals, which is always a big flagging red signal that something's off.
And Kevin, I quickly want to bring you in on this because Circle is certainly not the only stock that we've seen behaving like this as of late. It feels like we've had a return of the FOMO meme stock trade to some extent. Do you think that's happening, and what is that reflective of?
Well, within the broader retailer universe, which, from a retail trader or investor perspective, I mean, we've got a pretty good perch, from which we sit to see that. It's been less about actually fear of missing out. I think it's been actually more about fear of getting out, not wanting to, reduce your equity exposure, which we didn't see a ton of that on the retail side, even when you went through a lot of the stress associated with early April. It's actually institutions that have had to catch up a lot more. All the data we've seen from a positioning standpoint is that there was not this massive washout as you move towards the retail end of things. If anything, all of the weakness in sentiment, all of that washout was actually on the attitudinal side. It wasn't necessarily on the behavioral side. So you had, surveys like AAII or Investors Intelligence telling you that, things were at their most bearish since 2022 or even 2020, but that wasn't necessarily reflected in equity market positioning. And, for everything considered over the past, I would date it back to COVID, the retail trader or investor has been dead right in all of these moments where it's been by the dip and it's been, use that sort of whoosh down, to use a technical term, to your advantage, because it has been sort of the right call to make. We haven't gone through a protracted bear market in terms of duration. It's been more about depth, but the depth has been sharp, but it's been short-lived relatively.
Yeah. All right. Thank you so much. And Dan, thank you so much for coming in. It's great to see you. Appreciate it. Coming up, a big change to credit score policy for mortgages. We'll discuss what it would mean for home buyers next. The Federal Housing Finance Agency will allow applicants to use a VantageScore credit score for mortgages sold to Fannie Mae and Freddie Mac. That decision, the aim is to increase competition in the credit score market and expand access to mortgages. Joining me to discuss what this news means for would-be homebuyers is Silvio Tavares, VantageScore CEO and president. Obviously, it's good news for you guys, Silvio, so congratulations to you on this front. But this is a big change. The so-called FICO score has been sort of the benchmark within the mortgage market for a long time. So how VantageScore scores folks different from that traditional method?
Well, thank you, Julie, and great to be on with you. The simple answer to your question is VantageScore includes many more consumers, about 33 million more consumers. And about a third of that group are actually going to have a VantageScore 620 or and above, which means that many more consumers for the first time are going to have the opportunity to have a Fannie or Freddie Mac backed mortgage. It's a huge, huge change. It's going to include more people that have been left behind. And it's a benefit not just for competition, but also for many American home buyers who are going to get their first chance to own a home.
Silvio, there are always a lot of tips that people like to offer how to boost your credit score. If they're looking specifically through the VantageScore lens, how would they go about doing that?
Well, one of the big differences with VantageScore, one of the reasons why it's more modern and why the FHFA has approved it, and we thank Director Pulte for making this decisive decision yesterday. One of the things that's different about us is we include alternative data. If you ask the average American, hey, if I pay my rent on time for 10 years, does that boost my credit score? Most consumers would think the answer is yes, but for our competitor score, the answer is no. For VantageScore, we include that rental data. It's obvious that that actually is a big indicator of creditworthiness. And as a result, many consumers are going to have a higher VantageScore and actually have a credit score for the first time by doing things like reporting their rental data to their credit score. We're the only major national score that does that. We were the first to do it. We also use very innovative new analytics techniques, and we're the first credit score to do that. So that's really what's behind the FHFA's decision. It's a big, big move for the industry and a big positive move in the right direction at a time when, quite frankly, it's very difficult to buy a home.
Indeed, it is because of where we see interest rates and the affordability crisis, Silvio. So put some numbers on it for me. How many people overall, and maybe underbanked people specifically, may be in a position to become home buyers as a result of this?
Well, we estimate that of the 33 million in total that VantageScore provides a credit score that don't have a credit score with our competitor, approximately 4.9 million of that group would be mortgage eligible. These are consumers with a VantageScore of 620 or above. 620 is basically the minimum number that you need to qualify for a mortgage. And if you think about 1.83 adults in the typical household between ages 25 and 65, that adds up to $1 trillion in incremental mortgages in the United States. So this is a big, big deal. And while we are very pleased about the FHFA's decision that was taken pursuant to the 2018 Credit Score Competition Act, we're very pleased about this for VantageScore and its owners. Really, we're even more happy for the millions of forgotten Americans that are actually creditworthy and are going to get their first chance at a mortgage. Owning a home is a really key pathway to economic prosperity in America. It's a core part of the American dream, and we are just really excited to be a small contribution to enabling more people to get access to a mortgage and own their own first home.
Silvio, just quickly, this rule change, if I understand it correctly, it does still give leeway for the FICO score to be used. It's more that it gives a choice, right? So how then will that choice be made, and what gives you the confidence that VantageScore is the score that's going to be used?
Well, that confidence comes from the fact that in every segment where we've been able to compete, we have typically become the number 1 or 2 credit score provider. It's not well known, but over 3,700 banks, fintechs, credit unions, and government agencies use the VantageScore today. The only reason why until yesterday VantageScore was not used in mortgage is because of an unintended monopoly that was given to our competitor. That monopoly has now been demolished, and that means we're going to be able to compete because VantageScore's score is more inclusive and is also much more modern and much more advanced and more predictive. All of the major banks that have looked at our data have concluded that, whether it's Bank of America or Chase, the nation's largest bank, the VantageScore is better. And as a result, more people are going to have access to credit that, in fact, creditworthy. And also more banks are going to be able to make more loans with a lower risk than ever before. Really exciting.
Silvia, thank you so much for joining us. It's good to see you.
Great to see you, Julie. Thanks for having me.
And finally, just want to get some final thoughts with Kevin Gordon. I want to talk about the upcoming earnings season because I noticed a really interesting stat here in the Yardeni newsletter of Ed Yardeni. He talked about the consensus growth rate for second quarter earnings was 8.5% at the start of the year. It's 3.7% now. He says that's going to be easy to beat. What do you think?
Yeah, you know, what's been interesting, if you look at that white line in particular, what was fascinating about the first quarter earnings season was you started at a really low bar. You were almost at mid-single digits for expected earnings growth in the first quarter. Analysts were sort of flying blind as to how much of an impact anything tariff-related was going to have. Not that tariffs were on in the first quarter, but if companies were already struggling heading into this year, clearly that wasn't the case because you had that massive hook higher in that line. None of that was extrapolated, if you look at the other three lines, none of that was extrapolated to the rest of the year. So I think that one thing that could be interesting for the rest of the year, especially for second quarter season, reporting season, is if companies just easily sort of skip over that bar. And if there's kind of going to be this solid guidance take because they have no idea how to maybe price in any of it.